Hello, this is Japanese Economic Review Channel. Today we analyze Japan's March 2026 industrial production. Overall output contracted by 0.5% in March, showing a seesaw dynamic. However, this top-line decline masks underlying resilience, such as a 1.7% growth in production machinery. Let's explore the data. While March saw across-the-board contractions in production, shipments, and inventories, this is a temporary seesaw effect. Forecasts project a strong rebound, a 2.1% surge in April and 2.2% in May, transitioning from destocking to a restocking cycle. Our vital signs for March show production down 0.5% and shipments down 1.1%. Crucially, inventories also dropped 1.5%, marking the first decline in 2 months. This simultaneous drop indicates active inventory clearing, not just a demand collapse. The 0.5% decline hides deep sectoral divergence. We see strong growth in production machinery, plus 1.7%, and transport excluding autos, plus 1.3%. Conversely, foundational sectors like chemicals plunged 8.6%, and petroleum dropped 7.7%, dragging the index. Diving into the contractions, the 8.6% drop in chemicals was driven by regular plant maintenance and Middle East tensions. However, adequate 1.8-month stockpiles ensured domestic supply stability. Petroleum's 7.7% drop reflects shifting demands like reduced kerosene usage. Despite top-line weakness, capital equipment is thriving. Semiconductor manufacturing equipment and aircraft engine parts show robust growth. This resilience in high-value, specialized manufacturing provides a critical counterweight to the materials sector slowdown. A key pivot is happening in heavy industry. Auto production stalled at 0.0%. In stark contrast, production machinery saw a 1.7% output rise alongside a massive 8.4% inventory drop. This signals robust CapEx demand, rapidly outpacing current output levels. The tech ecosystem shows a fascinating dynamic. Upstream electronic parts inventories grew 4.0% as firms anticipate hardware demand. Meanwhile, downstream info/comm machinery cleared 4.2% of its finished goods inventory, making room for new production. Foundational inputs, chemicals, petroleum, and steel, experienced synchronized drops in production and inventory. Despite production drops, jet fuel supply grew 11.7% YoY to meet demand. Yet overall downstream hesitancy to accumulate raw materials remains. Our phase analysis places Japanese industry firmly in a destocking cycle. Because both production and inventories contracted together, manufacturers are intentionally clearing out warehouse stock. This strategic drawdown paves the way for a Q2 production ramp-up. Looking ahead, the destocking phase sets the stage for an aggressive Q2 rebound. April is projected to surge 2.1%, driven by production machinery and electronic parts. May follows with a 2.2% increase, confirming a strong restocking cycle is imminent. To conclude, first, prepare for a sharp restocking influx. Second, robust CapEx demand signals resilience in semiconductor manufacturing. Finally, monitor base materials, as the upcoming Q2 surge could rapidly drain remaining raw material inventories. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.